It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
Hello out there. My name is Mikkel Rosenvold. Welcome to another edition of Macro Mondays with my great friend Andreas Steno in the studio.
Hey, Mikkel.
Nice to see you, Andreas. We're sending to you live from summer-stricken Copenhagen, and we're recording this on top of a very, very busy weekend. Sometimes we record this, to be quite frank, on Fridays and then release on Mondays. This time we actually, for practical reasons, decided to postpone our recording to Monday morning European time. And
probably a good idea.
That was probably a good idea because of what happened last night. So let's head right into it, Andreas. Just to get things kicked off. Luckily, I wasn't caught in a diner in Washington, D.C. sipping Wolf Spritzer drinks as the CNN anchor Wolf Blitzer was, but it was still quite a bombshell that hit us last night with Biden dropping out of the presidential race. We'll be covering that a lot more, looking a lot more into Kamala Harris as his potential heir, looking at the presidential race as a whole. Aside from that, Andreas, we're going to be looking at the great stock rotation going on. Going to look a little bit on the Chinese plenum that happened last week. Maybe a stroke, maybe not a stroke for Xi Jinping. We'll look a little bit into that. And then actually turn on the long side to look 12 to 18 months ahead at the macro landscape. You did a great piece. Also yesterday and Sunday on this.
Yeah, Mikkel, and one thing I can guarantee about that when we look 12, 18 months ahead is that everything I'll say in that section will be wrong.
It could be. Yeah. Perhaps that's a good time to post our usual disclaimer that all the recommendation, the analysis here, it may be...
Sometimes may be good, sometimes may be shit.
That's just the way it is.
Yeah,
but we'll try and have fun in the meantime. So, Andreas, let's head right into it. Joe Biden has stepped out of the presidential race. He hasn't stepped down from the presidency yet, even though there are great calls for him to do that. We'll see if that happens. Initially, in his first statement, he didn't endorse Kamala Harris. But then 10 minutes later, he did. I just got wrong-footed by that initially. But he did basically endorse Kamala Harris for the Democratic nomination. So essentially, we're looking into a Democratic convention where they will have to pick another candidate, even though Joe Biden obviously won the primaries. And Kamala Harris is very much looking as like the front runner right now. I noted that Barack Obama didn't throw his weight behind her at once. That might leave a little bit of a slight opening for the candidates, but it has to come really, really quickly because Kamala Harris is slowly gobbling up all the donations, all the funds that are going into the Democratic Party, and she is emerging as the leader. So Andreas, let's just quickly cover two main questions. Can Kamala Harris beat Donald Trump, and what should we expect if she in fact does beat Donald Trump? Just to have that covered.
You want my take on that first?
Absolutely.
Just a quick no. I don't think so. Let's just be honest here. We're sitting here in Europe discussing U.S. politics, and it's obviously tricky for us to gauge the sentiment among the voters in the U.S. But I'm far from impressed with her. To be honest. So, Mikkel, let's have a look at the numbers.
Yeah, absolutely. I mean, she's not doing too well one-on-one or even in this five-way race, which is really what you should be looking at against Trump. Here I've taken the past section of polls out of Real Clear Politics, which sort of collects all the polls from the major networks, and what we're seeing is a very clear lead for Trump. This is obviously before her being nominated or being the nominee, so it is a bit more of a hypothetical vote. People might change their opinion now that they actually have to form an opinion on Harris. A lot of voters will do that. Still, it's not looking very good. What we have to remember in this is that Harris needs to win by at least 1 point, if not 2 or 3, to win the general general election because the electoral college is a little bit skewed towards the Republicans. So not looking too good for Kamala Harris. Probably not worse than it would have looked for Joe Biden, and that's probably where the Democrats are hanging their head right now. That she could revitalize the whole election campaign in some sorts. She could try and make Trump look old, basically. Kamala Harris is 59 herself, so in European terms, she would be quite old for politics. In US terms, she's very, very young. That's the way it is. Anyway, what I'm actually looking more at than these polls, because I agree with you that Donald Trump is still the heavy frontrunner, is how Harris entering the race will affect the congressional vote. Yeah. We're looking at contests on both the House and the Senate in the fall as well, looking very, very tight right now. I had a feeling that this whole Trump feel-good factor would spill over into the congressional votes. Kamala Harris might have a chance to actually flip this. That's one thing we'll have to watch over the coming months, because that is going to be very, very, very crucial for how either Biden or either Trump or Harris will be able to do their jobs as president.
Yeah, I mean, one thing that we've obviously discussed with clients over the past week, Mikkel, is whether we could get a quote unquote a red sweep in this election, right? And that would obviously change the picture from an economic perspective if Donald Trump and the Republican Party basically had sort of the leeway to just pass through legislation right, left, and center. But it doesn't really look like they'll get that red sweep, at least if we look at opinion polls right now. Not
at the moment. We'll have to watch that. That may be the thing to watch for November rather than the presidential race. Another question we've had, Andreas, is what would a Harris presidency look like in economic terms? It's not the most likely scenario, but we have to prepare for it anyway. I found a little clip a couple of years ago from Kamala Harris explaining what she calls inclusive entrepreneurship and inclusive capitalism that may lay out some of her foundations here.
Inclusive capitalism, how do you think it can be, it can address the most pressing issues, especially equality of opportunity, specifically regarding gender, race, and ethnicity, age, and socioeconomic background?
So capitalism in its best form is about the beauty of competition to create the greatest product, to create the greatest outcome. But inherent in that is an assumption that everyone starts out on the same base, and then they compete, and whoever wins, wins. The market, right? The market share. But that's a false assumption when you take into account the fact that not everyone starts from the same place, particularly when we take into account race and gender. So what we have to do is recognize the disparities that have long existed and take that into consideration when we want to encourage competition. And that includes, for example, what I'm doing around women-owned small businesses, minority-owned small businesses, and giving people equal access to compete. That at its core will produce the best outcome for all, for the customer, for society, for our economy, and in the interest of the best of what capitalism should encourage and create.
So, Andreas, to sum this up, a bunch of mumbo-jumbo, in my opinion. Very clearly, Kamala Harris, in my view, has no real economic philosophy. That's my take from this. She may have some fundamental ideology on how capitalism should work, but she's not going to storm into the offices of Jay Powell and tell him how to do his job. No. She's simply not capable of doing that. It doesn't interest her, and that's why we should really watch what's her team going to look like. What's her potential cabinet going to look like? I see some similarities from this to the George W. Bush presidency. When he entered office, he had basically no idea on foreign policy, didn't interest him at all. Then 9/11 happened, and then his team had to formulate the neoconservative strategy for him. I think that could be very much what we're looking at with Kamala Harris. She is going to be grasping at straws. She's not an economics politician, so we'll have to watch her team. It could be centered around Perhaps higher taxes. I think she's going to have a hard time getting that through Congress. Could be increased investment in housing, a more social IRA, but still, I really don't think she has a lot of opinions, basically, on how the economy should be run.
No, I think that's. I mean, if you'd ask me the question, how will a Kamala presidency look like from a macro perspective? My answer would be, I have no clue.
Exactly.
I have no clue, and therefore I'm really keen on watching market developments over the next couple of weeks here. Should Kamala gain some sort of momentum, because then we'll probably get a feeling for the overall sentiment around her potential policies. But I'm not sure that we have any like firm guidelines from her right now, honestly.
That's the honest answer.
Yeah. And I'm kind of inclined to say that a Kamala presidency would be very good news for big tech.
Yeah.
Just because they get the opportunity to basically formulate her policy to a certain extent. At least if they sort of obey to some of the principles that she laid out here. But I mean, that would be my 2 cents right now.
Yeah. On the other hand, we are seeing Mark Zuckerberg, Elon Musk, obviously, throwing in the hat to kiss Trump's ring, basically.
Yeah.
We've seen Mark Zuckerberg, what was his wording? That Trump was a badass.
Yeah.
So we are seeing big tech trying to get into the good graces of Donald Trump in
sure.
expectation of him winning. He is, some have called him a mercantilist president. I think if Mark Zuckerberg pleases Trump, and then comes to him with a wish list, Trump could be quite accommodative of that. So I think both. It's a very different scenario for big tech, whether it's a Kamala Harris presidency or a Trump presidency.
Yeah.
We'll have to see. We'll follow up on that in coming weeks. This is what we know so far. To be completely transparent, it's very, very hard to predict what KAMALANOMICS could look like. I don't think she even knows herself. So let's move on to something that we do know a little more about, Andreas. A great rotation is the big topic right now, from large cap companies to smaller cap companies. Why is this happening right now?
Well, I guess the vanilla explanation is that a lot of people saw what happened at the Trump rally a weekend ago. Started to price in a larger probability of this red sweep across the country, potential new rate cuts, a removal of red tape, and all of that for small and medium-sized corporations. So, I mean, it looks very reminiscent of what happened around the 2016 election. I'm honestly a little bit puzzled myself right now. I'm not sure that the principles or the foundation for doing business as an SME those foundations that they've changed over the past 10 days, really. But we're talking about trying to price in the probability of the future outcome for taxation and red tape. And I mean, it's not necessarily unfair that you price in a larger probability of the Trump administration trying to do some more tax cuts. So that's essentially what we're up against. Yeah. And the interesting thing here is Mikkel, and you could look at it from an earnings perspective as well. I mean, when you look at earnings per share in the large cap and the small cap space, we've seen one of the larger divergences in modern history, basically over the past couple of years. And it seems like this post-COVID, post-lockdown economy essentially ended up being great news for the blue chip companies, the Silicon Valley companies, while the opposite happened in the Midwest and other of these regions. But there are, I mean, this chart on the earnings per share development in large cap versus small cap is very telling, obviously. But there are some signs beneath the hood of some sort of normalization of this gap. And we can essentially see that from some of the forward-looking indicators that we'll discuss in the second half of this show, with slightly better profit expectations from some of them sort of broader companies in the US economy. And that's essentially what's needed to bring about a more permanent rotation into other sectors in the US economy. So in all honesty, we've been long the mega tech, mega cap companies into this little rotation that we've seen over the past week, and it's obviously been wrong-footed.
Absolutely. Andreas, let's round off the trading topics of the past week by looking a little bit at China. This guy, Xi Jinping, was at the head of the Chinese Communist Party plenum. We talked about this last week as well. And as it always often is about these Chinese policy meetings, we get a communique, and it's very, very hard to grasp what has actually been decided. A lot of it is usually leaked over the coming weeks. We do have a little bit of knowledge. Let's start in the political scene. We'll get back to the financial one. So first of all, this is our meme of the week. Obviously, we don't want to make fun of anyone having a stroke, if that's really what happened to Xi Jinping. Rumors emerged, mainly from Russian sources, that Xi Jinping had suffered a stroke. And then this picture emerged as well. The meme states, has Xi Jinping drinking, sipping coffee at a meeting table, and then making a very, very grim face. And the text is, when someone puts human rights in your tea instead of sugar. I'm not sure if this was caused by human rights or a stroke, or he passed out or what. It didn't look too good. Anyway, he's not up for election, so he can take whatever time off he needs. One thing I did note, and that's one thing to always look for in these Chinese communique, is the details in the language. So we had two major firings. The foreign minister, Qin Gang, was fired a long time ago. It was basically formalized here. He was still addressed as Comrade Qin Gang in the communique. That means that he's still sort of...
He's still alive.
Yeah. Aside from that, the former defense minister, Li Shangfu, was not called a comrade. So he's probably, if this was the Hells Angels or Banditas, he would be called in bad standing, essentially, and will most probably try and leave for Singapore. What do we know? Yeah. Just a little subtle detail of all these Chinese communiques.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
So, Mikkel, can I add one thing on this? I read the translated version of this communique on the English version of China Daily, and I mean, I took notice of the sentence that they plan on modernizing the Chinese model ahead of 2035. So basically 10 years from now, roughly. And then they write that they need to implement the reforms needed to get there by 2029.
Yeah.
So again, I mean, at least the foundation of their communication is very medium term.
It is.
And then you're right. We're slowly but surely getting the leaks from this plenum. We've seen some leaks around how they're going to spend this special long-term bond that they issued a short while back. But again, it's kind of known size-wise what kind of stimulus we're talking about here, so it's nothing major for markets. And then all of a sudden, the night between Sunday and Monday, they cut interest rates again.
Yeah.
And to me, that's the most formal signal you can get that they couldn't agree on anything stimulative, very short term, outside of just letting the central bank cut interest rates again.
That would be my take as well. That is the only form of stimulus that they could agree upon.
Yeah, kind of low key, right?
Yeah, exactly. So that's basically where we're at. I think this is an indicator that they are trying to boost GDP to reach their 5% target. They probably decide themselves if they want to reach it or not. But still, there are some signals to this also internally in China. So that's what we're looking at right now.
Yeah.
What are the effects of this rate cut?
Well, I mean, when you look at it on the surface, it's obviously not good news for the local currency. But the last sort of empirical playbook we have to look into here on rate cuts in China dates back to June 2023, where they cut the 7-day repo rate, bringing liquidity into the financial system. But they also subsequently cut the interest rate called the loan prime rate, which is more linked to the mortgage market, basically. And they did the exact same thing here overnight, 10 basis points to each of these interest rates. And in contrast to what's probably the main takeaway right now in the mainstream media, we actually got some sort of short-term revival of the momentum trade in China. And my best guess would be that this is, another short-term hint that markets will try and chase Chinese assets higher short-term. Again, they haven't solved anything with these minuscule rate cuts, but the short-term takeaway is pretty decent. One thing to note, and we'll get back to this when we discuss what to trade in the upcoming weeks, we got the export numbers from the Chinese economy, was it last week? And if you haven't checked out those numbers yet, go take a look at Chinese copper exports. By the way, also aluminum exports in June. The chart is through the roof. So why on earth are they exporting critical resources right, left, and center if their local economy is doing well? It's not. They have no use for copper in the volumes that they're refining locally, so they simply need to sell it.
Very interesting. We'll get a little bit back to copper and metals and commodities in general. Before we look ahead at the macro landscape for the coming year and a half, remember that this is a sneak peek into the stuff that we did at StenoResearch.com, both on geopolitics and macro. We try and use the show also to give a sneak peek into some of the data models. We'll get a little bit back into that, where we have some snippets from our PCA tool a little later. And generally, what you find on StenoResearch.com is going to be very, very chart heavy. That is to be expected. One sort of chart that we do not use very much, I don't think we've ever used it potentially, is the Venn diagram. And in that, we are in stark contrast to potentially the next president of the United States, Kamala Harris. Let's have the soundbite of the week here.
All right. So, we've shown you Kamala Harris from time to time where she's had some amazing sound bites. Today, we're going to show you a conversation yesterday that, as we've done some digging, as it turns out, she is fascinated with something we all learned, most of us learned in 3rd, 4th, or 5th grade, the Venn diagram. The circles? She loves them. Watch.
Think of it then in the context of, I like to think about a lot of things in the context of a Venn diagram. I love Venn diagrams. Always ask, is there a Venn diagram for this? I'm telling you, it's fascinating when you do. So Venn diagram, those 3 circles, right? And if you want to add some more circles to the Venn diagram, the solutions also look like what we need to do to invest in a clean energy economy.
The Venn diagram brings so much delight to her. She is a Venn diagram enthusiast. The Venn diagram are those overlapping circles, there. The similarities are in the orange, and the differences are in the outer parts of the yellow circles.
I haven't seen her that happy since the Space Actor kids. She was really, that's the only thing that compares.
Brian, there's so many memes.
This is what to expect. I think the Jay Powell needs to brush up his Venn diagram skills. But
Mikkel, in all honesty, when you look at the average complexity of our charts, we probably should use a few Venn diagrams here and there.
Very true. Very true.
Because even our own employees, they don't get what we put in the charts. So
no. Yeah. We stick to memes instead. Let's have a meme president for the next one to have everything explained in memes. So, Andreas, you did a great piece on the macro landscape for the coming 12 to 18 months. How much can we say about the macro landscape in that time frame?
Not a whole lot. Not with a strong degree of accuracy, at least. So instead, what I like to focus on when I look a bit ahead is how's the market currently positioned? Is there any potential triggers for a complete wrong footing of the current market positioning? And what are the quote-unquote forward-looking indicators telling me about the momentum from here? I don't know the exact level of GDP in a year from now. No one does. But what we can discuss is whether the direction of travel is up or down. And I'm starting to convince myself that a lot of the forward-looking indicators look a lot brighter than what's generally the understanding out there, and that we're probably very early in the cycle rather than late in the cycle, or at least we're not in a part of the cycle where we should really worry about the recession. And I mean, a lot of people still worry about that recession, especially given some of the PMIs that we've seen and so on and so forth, Mikkel. So let's have a look at why.
Let's have a look at that. Yeah. So you narrow it down to three main questions here.
Yeah.
First of all, is liquidity no longer improving, but rather at risk of weakening in the coming months? And you put up this chart. Probably should have been a Venn diagram of how the Fed keep liquidity conditions stable to increasing. What's the outlook here?
So my base case is still the dotted dark blue line on this chart. So basically an addition of liquidity to the extent of 300 to 400 billion for the rest of the year. We've seen a sell-off in technology. We've seen a sell-off in consumer discretionary. So some of the equity sectors typically very sensitive to liquidity trends. So is that some sort of forewarning of weaker liquidity in the market? I'm not sure it is, and I have a couple of reasons why. First of all, do note that we are currently amidst a clearly negative running correlation on a 90-day basis between Bitcoin and technology stocks, for example. And we've seen that 6 times since the pandemic. And each and every time we've seen Bitcoin and crypto leading the way higher when we've seen such a divergence between tech and crypto. My take is that crypto is even more sensitive to liquidity than technology stocks. And therefore, the rebound that we've seen in Bitcoin, ETH, etc., over the past week is probably good news for those fearing this liquidity drawdown. So why is liquidity improving? Well, we have 2 sources of liquidity for the rest of the year. The first wave over the next 6 weeks is driven by what I call the overnight reverse repo facility. So basically a facility that hosts a bunch of billions of dollars for money market funds. And when the US Treasury issues on a net basis more T-bills, these money market funds will be incentivized to buy these T-bills instead of parking the dollars on this facility. The main risk here, and one of the very clear technicalities that's being discussed right now, is whether we've already found some sort of de facto natural flaw on the overnight reverse repo facility. So remember, these money market funds are still economically incentivized to buy the bills, withdrawing the dollars from the Fed in the process of doing so. But they also need to send a signal to the Federal Reserve that they still want an allotment in this reverse repo setup, that the facility is still needed. So they cannot bring the facility to zero, because that would sort of hint to policymakers that it's no longer needed and they don't need their allotments on a fund-by-fund basis. So of course they'll leave something in this facility just to signal that they need it. We don't know this natural flaw level, the level of it, and we could be wrong-footed by the natural flow level already being found. I wouldn't rule that out. On the other hand, we also see a clear tendency towards the so-called Treasury general account being emptied ahead of debt ceiling deadlines. And this is very important because we are 1 week away from getting the quarterly refunding announcement from Janet Yellen and her team in the US Treasury. And they will obviously communicate that they intend on increasing the debt load of the US Treasury by $1.25 trillion or something. You know the drill, right? Despite this looming debt ceiling deadline. But they always do that. I mean, they cannot assume that politicians will not reach a deal. So they'll have to just state that we'll keep on issuing. But very mechanically, they'll have to stop issuing debt once we get closer to that debt ceiling deadline, because they're not allowed to hold, say, $1 trillion or close to $1 trillion in idle firepower in this Treasury general account a couple of weeks ahead of that deadline, because that will obviously incentivize politicians to not agree. So by design, they will be tasked with bringing this TGA account at the Federal Reserve down ahead of the deadline, which is 1st of Jan, as far as I remember, right? So a point being here that we'll get a liquidity addition from the U.S. Treasury, no matter whether they want it or not, towards the end of the year. So I'm pretty certain that we'll get a liquidity increase, but there are some technicalities pointing in the other direction. Also worth, and now I'm basically moving myself into a rabbit hole here.
Absolutely.
But I've noted how the refinancing activity in the mortgage space has picked up lately, among other things due to the drop in mortgage rates. And when the refinancing activity picks up, it basically means that more mortgage-backed securities will mature in the SOMA portfolio at the Federal Reserve. And that means that QT will be more potent. So we'll get an increase in the QT pace, despite the Fed not wanting it, over the next weeks as well. So we need to get these liquidity additions from various technicalities. And I think we'll get them because, I mean, take a look at the chart since September 2023. We were supposed to see an environment of declining liquidity, and we haven't. So some of these technicalities, they're used actively beneath the hood to try and stabilize liquidity and bring liquidity higher.
Very interesting. Let's move a little bit ahead and look at the next question. Is the economy accelerating rather than slowing? The big one. So one piece of evidence is numbers out of the Philadelphia Fed, which hints at a material re-acceleration. So is that your base case that we're actually accelerating rather than slowing right now?
Okay, so there is one caveat to this. The manufacturing sector, which is basically the sector that is covered by the survey from Philly Fed, will get the service equivalent to this tomorrow. The manufacturing sector didn't really work as a leading indicator for the broader economy in 2022, 2023. As you can see, we actually had a decline in that sector and nothing happened in the broader economy. So it could be, now that we're seeing a crystal clear acceleration here, that it doesn't really matter for the broader economy either. So that's kind of the flip side of this. But other than that, I mean, the strongest report in years, everything in that report is like 2 standard deviations through the roof. So manufacturing will do well during the second half of the year. I can basically promise you that because this survey is the best predictor of what's going to happen in ISM manufacturing a couple of quarters down the road. So yes, we are seeing an acceleration in the US economy beneath the hood. And I especially like the next indicator that I've brought with me, Mikkel, from the NABE Business Conditions Survey. It's sometimes an overlooked survey. It's not particularly large. We're talking a sample of, say, 80, 90 companies. But it's very broad. So we're talking a sample in everything from utilities to finance to materials. I mean, a broad sector sample relative to what we see elsewhere. And take a look at profits 2 quarters forward. Versus employment here. We actually, just before we went on air, got the update from the NABE survey from the second quarter. It still looks roughly like this. And point being here, profit expectations are up. Prices charged are up. They are even above 2022 levels in this survey. So basically, a larger portion, net, of companies surveyed will hike prices during the second half of the year. And that's to an even larger extent than in 2022. That kind of stuff doesn't happen in an economy that is slowing. And what you can see from the chart here is also when you charge higher prices, when you expect profit margins to increase, you hire after a while. So, I mean, hiring is a delayed response to the profit cycle, and the profit cycle is improving. So sure, I'm not blind to the risks that unemployment will go up now. I'm not blind to the risk that we'll get a few weak non-farm payrolls reports, but it will be short-lived. That's what I'm saying.
Very interesting. Last question here. Is the commodity complex heavily undervalued or overvalued? Should we start up with looking at ISM versus copper, or do you want to?
Sure. We get a lot of questions. I mean, we've been banging the drum on this short copper trade week in and week out. It's been performing tremendously well. But how on earth can we be short like industrial metals when we think the economy is accelerating. It doesn't really rhyme, right? The point here is that the domestic economy in China is not doing well at all. The apparent consumption of copper is down 35% in China. And remember that China is by far the largest consumer of metals on earth. And I cannot underscore by far enough. All of the roads and bridges to nowhere basically drove the whole bit for critical resources through the 2010s. And that bit is gone. And correct me if you have a different understanding of that plenum. We're not talking about roads and bridges and hotels and all that noise from China once again. And they're not going down that road again.
Absolutely not. No. What they're trying to do is try to save the fallout from that entire campaign and try and save all the regions that have been debt-stricken.
And they allow the regions to tax, at least indirectly tax their people a little bit more, right?
Exactly.
To try and match the budgets. Yeah. And I guess what I'm trying to say here is that we can actually get a reacceleration of the cyclical part of the economy and still have a Chinese domestic economy that is no longer using the same amount of copper as it did a few years ago.
Absolutely.
And therefore, that major demand for copper that came from China, it needs to be replaced, and it will take years. So that super cycle logic around copper that, oh my God, we'll run out of copper this year. I mean, my best guess is that we'll have all-time high inventories of copper in the US and in London, or the LME, within 3 months from now. That's my best guess. A lot of copper is moving westwards right now. And we haven't brought the chart here, but the copper exports from China in June were twice as high, more or less, as in May. And May was an all-time record by quite the margin already. We're getting flooded with copper. Flooded, absolutely flooded.
We're covering this extensively on stenoresearch.com, so you can check out that chart and other charts on there. Just one last thing I'd like to show and discuss, Andreas, is a sneak peek into our PCA tool. Now, this may look a little bit raw, but this is basically, and you can explain the model, but basically the most misaligned trades right now.
Yeah.
What does that mean?
Well, what we do in this PCA tool is that we map all macro assets, so basically equities across all geographies, all currencies, all fixed income trades, all commodity trades, versus 10 macro variables. Those 10 macro variables range from dollar liquidity to inflation expectations, stuff like that, right? Critical macro developments happening beneath the hood. And this model on a running basis points out when an asset is moving out of tandem with the overall macro cycle. And what you can see here is that the UK construction sector, basically the equity sector on construction in the UK, trades 3 standard deviations away from the macro developments. Probably due to Keir Starmer building right, left, and center, at least promising to. So this is very clearly the Labour bet after they won the election. But you can also see the sterling versus the Canadian dollar and the sterling versus the US dollar gaining too much relative to the underlying fundamentals of the UK economy. That's basically what it's saying here. So we sold a bit of cable on the back of this. And this is a very, very good tool that we give our clients access to, obviously.
Absolutely. In my opinion, this exactly shows why this model works, because this model doesn't factor in the election of a new prime minister.
Sure.
So it shows that it flags the U.S. construction sector, which it should, and then you can always put in the human element of saying, oh, but that's
that's an idiosyncratic factor.
Yeah, exactly. But it shows that the tool points out what it should. Anyway, just a sneak peek into that. Check out a lot more on that on stenoresearch.com or contact us for more. I want to round off, Andreas. We've gone over time as usual by taking a very a peek into our trading portfolio. Do you have any idea of where our macro regime indicator is going to go next month? What do you expect? I know you have an idea of that, but what's your feeling right now?
Yeah, so I still think it's very correct that liquidity is going up. I still think it's correct that inflation is going down.
Yeah.
It's debatable whether growth is going up right now. Also, as you can see from the commodity space. We're rather talking QE-like, so liquidity up, inflation down, growth down, than growth up right now. And that's why you need to be long liquidity-sensitive assets, for example, crypto, while you need to be short growth-sensitive assets, especially sensitive assets to the domestic Chinese growth story, because it's still very weak, and we're going to see that excess capacity of smelters and refiners bringing that capacity to the West in the commodity space over the next 6-8 weeks.
Very interesting, very actionable. I think that's all we had for today, Andreas. As always, you can check out all our research at stenoresearch.com. Follow Andreas and me on X and other places. It's getting really hot in the studio, so I think we'll wrap it up for now. Thanks to you, Andreas, for joining, and thanks to all of you out there for watching. We'll see you all next Monday.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at TOKEN2049.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.